I think most people know this. We're building S2G around sort of 5 core transitions that we think the world is going through at once. It's sort of this emerging reality that we talked about yesterday. AI, multipolar geopolitics, an unknown price of money, 2.5 degree heating, and then aging. And that's really what we've curated over the next 4 hours or 3 hours. It's pretty tight. Really sort of, yesterday was sort of recognizing that when these things happen, there's a financing gap that occurs because these new emerging realities over the last 300 years, there was always a financing gap, whether it was sort of how do you fund mercantilism 300 years ago to how do you fund today, power, compute, et cetera. So really, this is sort of systems thinking and investing, and we've got a great set of speakers. I'm just going to set up sort of the so what a little bit, because I think, these forces are accelerating. Just sort of in the last year, we've seen 70% growth in AI CapEx, significant growth in frontier model capability. Clearly, the bet always was, do we go from training to inference to show really economic productive use cases? Inference is clearly growing to kind of further bolster sort of the thesis that Don Wilson had and Jason Warner had around this. There's something happening from an AI perspective. Clearly, I was at a similar convening about 2 weeks ago, and it was sort of, it's geopolitics stupid, similar to how economics featured in the 90s from a political perspective. But, it's a multipolar world. You've got concerns around the future of the dollar. Defense spending is rising. Europe is playing a disproportionate role, and we've had the most conflicts since 1946. To me, one of the most, and this is what we got into with Don a little bit, since the early 90s, the marginal buyer of the 10-year treasury, which then drives real estate markets, private credit, lots of markets, I think, was known. You had Japan, you had China, you had central banks. I think that's in question, and it's going to have dramatic impacts on cost of capital, which it directly or indirectly impacts everyone in this room, from credit card bills to mortgages to, financing your companies. And we haven't even gotten into the full sort of deficit and contingent liabilities of aging, Medicare, Social Security, et cetera. So, we are, have significant monetary issues and driven by emerging fiscal issues. Increasingly, sort of 2.5 degrees is getting priced in by insurance, is having a drag on productivity. Food prices are increasing, and obviously maritime and ocean and shipping lanes are emerging, and that's going to create both issues and opportunities for global supply chains. And then sort of the aging dynamic is clearly something that I think is happening. If you take out South Asia, Africa, and parts of Southeast Asia, the rest of the world is aging. There's going to be more deaths than births by 2030. And so the combination of these things, we've been building S2G around, we've left the era of moderation, which was the, sort of the last 30 years, and we're entering the era of volatility. We're building the firm since COVID around this notion. What does that mean? So, my U.S. history teacher in high school, and Joe Malkoon, it's a couple from high school here. Money, not love, makes the world go around. I do think we're going to be, these aging entitlements, need for defense spending, the sovereign debt issue, and general entropy and black swan events. We're going to have a shrinking savings pool to fund a lot of things. Capital versus labor, that came up a bunch yesterday. The lowest labor mobility in 30 years. Entry unemployment, I've heard a stat, it sort of was 5%, now 15%. And so you're clearly having issues around what's going to be the relationship between capital versus labor. In terms of correlations are breaking. A lot of modern portfolio theory was built on a set of correlations and asset classes between stocks and bonds. That's occurring. And this is before this is from a position we're stocked up on debt. We're stocked up on concentrations, whether it's in financial markets or in physical supply chains. And so at some point, the hangover is coming. I've been predicting a recession since 2010. So don't listen to me probably about macro. And so not that I've ever been accused of being academic or professorial. So you're like, these 5 things happen, who cares? I mean, they're going to happen every time we've had, but I think they're going to have an impact on investing and on company building. Obviously, we have a bet on 7 companies, 1 country, and 1 energy regime. If you think about our stock market, it's at significant historic highs in terms of the market cap to GDP. We're in debt. We're more and more liquid with our portfolios. So the things that built the last 30 years, I think, are starting to reverse or reverse. Globalization, correlations, rates. And so highs in bankruptcies, supply chain issues, capital structure, access. And the thing that sort of rewarded the last 30 years, in my view and our view, are not going to reward the next 10 years in terms of asset light, just in time, efficiencies. That with these 5 things that we've talked about are going to have impact. And so I was always taught, the value of any business is its scarcity value and or ability to generate cash flow. And these 5 things, I think, are going to impact what is scarce and what produces cash flow. And that's going to reorient market share, returns, who wins, who loses. So these are some of the things around every input to valuation: choke points, moats, profit pools, terminal value, multiples, inflation, pricing, are, in my view, going to get re-rated. And I hope that the speakers that come on are going to give you deep dives into each of those 5. So if you look at multiples, ideally, you want to buy low, sell high, or often buy high, sell higher. Least desirable is buy high, sell low. Don't do that. And if you look at the last 150 years, yeah, great company, but it's often what they would call vintage year or era. And this regime, we have had sort of every 20 years, the cycle changes. And in my opinion, 1968 to 1982 is the most comparable moment. The world went through those 4 transitions: Moore's Law, sort of the birth of globalization, the demographic dynamics that occurred, and obviously getting off the gold standard. And so those 5 transitions led to next 30 to 50 years of economic growth. I think these 5 are going to have impacts, and we don't know, but we're certainly starting from a place of 40 times PE. If you think about what drives multiples, it's these things. I'm not going to go into every, but this is something I think we should pay attention to as we think about this. Cash flow durability. 1 company's made it into the 21st century in terms of public companies. So in terms of what drives structural drivers of cash flow durability, it's, in my view, these 7 things. So when we think about intelligence, power, money, entropy, and aging, the impact they have on multiples and cash flow durability are very important. So these are the questions that I think we should be asking as we hear from our speakers this morning, and how both the scarcity value and ability to generate cash flow. So are you buying low, selling high, buying high, selling higher, or buying high and selling low? I think, and what is the cash flow and earnings that you're really doing? So that's sort of the setup for the day. I did not say beta or alpha once, so I think that's, so thank you. Please clap. Just joking. No, I was joking.